Hi, everyone, and welcome to our manufacturing webinar. My name is Jacob Cole. I'm the marketing coordinator here at CID. Today, Teresa Cochran, our property and liability underwriter, and Darby Fisher, our work comp underwriter, will be sharing their expertise in helping you fully understand how to insure manufacturers. We'll be going over the specific learning objectives in just a second, but before I pass it off to them, I wanted to quickly go over the logistics of this webinar. As you can tell, you're all muted, but there is a chat feature, so you can type your questions in at any time and we'll answer them throughout the webinar. A short survey will pop up after the webinar so you can help us improve these for you. So we appreciate you taking the time to fill that out. And without further ado, I'll pass it off to Teresa.
Thank you for joining, everyone. Our objectives today are to identify and understand the different types of manufacturers, to learn what coverages these businesses need, understand what information is required in order to obtain a quote, and learn how to get more manufacturing risks on the books. Because at the end of the day, we're all looking to write more business. To make this webinar happen, you are in for a special treat. We will have two underwriters presenting this webinar today. My coworker Darby will present the workers' comp exposures throughout the webinar, and I will present the general liability and property exposures. Our marketing coordinator, Jacob, will cover how to boost your manufacturing book of business. I would like to start by giving a brief overview of what the manufacturing industry is currently going through. Compared to last year, the manufacturing industry is forecasting a 4.2% increase in sales. To bypass the continuous supply chain disruptions that have been going on the past 4 to 5 years, many companies have prioritized domestic production or have relocated their facilities closer to the United States. Domestic production has also been given a boost due to federal incentive programs and a way for companies to reduce tariff challenges. Some manufacturing companies have invested in AI-powered automation and operation management systems to help maintain a steady supply with demand, and companies have been improving their workforce by offering employee training programs to gain skilled laborers. So all of this movement is making for a very positive outlook for the manufacturing industry and is showing to be a great industry to target. It is a common misconception that if a company is importing products and selling them to other businesses, that they are considered a distributor or a wholesaler. So I would like to take a moment to define what a manufacturer is. They import a product from a foreign country. They place their own name or label on a product. They may alter the product by repackaging or relabeling it. They may have their own product made in a foreign country. They also may create, produce, assemble, or make a final product or part that can be found in another entity's final product. In my experience, it's the first bullet point that tends to confuse my retail brokers the most. So let me explain it this way. When your client is importing a product from another country, they are now taking on the product liability exposure of that product. The end user of the imported product will not sue the company in China, Taiwan, or whatever foreign country it came from. They will sue your client's company because that is the company they purchased it from within the United States. On this next slide, Darby and I compiled a short list, but certainly not an all-inclusive list, of different manufacturing categories that we have success with. The manufacturers we see across our desk typically fit under these categories. Do you notice how aerospace, automotive, and chemical manufacturers are not listed? They aren't listed because those three categories are some of the hardest manufacturers to find a carrier for, and therefore ones we recommend avoiding. So let's say you are in contact with the owner of a manufacturing company. What types of questions do you think you should be asking to not only pre-qualify them as a good account to go after, but also to understand what their business is? It can be hard to understand manufacturing risks because there are so many different types, which is why it's really important to ask them questions. These are some of the questions that are running through my head when I'm looking over a new submission to see if it's something my carriers have an appetite for. What products are they selling? It's really helpful if the client can provide a company website address or marketing brochure that lists the items they are manufacturing and the types of materials being used to produce the product. Depending on the materials being used, product pollution liability may be a coverage they need or are required to obtain per their lease agreement. You will typically see a product pollution liability requirement with soap, oil, paint, and cleaning supply manufacturers. Where are the products being made? If the applicant says they are making the products in-house, they will have a need for business personal property to cover the equipment and tools used to make the products. And whether or not they make the products in-house or are importing the items, they will have a need to cover their inventory. Who is the end user of the product? This is helpful when the applicant is making a component part or a single piece of another entity's final product. So when someone calls saying they are making screws and bolts, finding out who the end user is important so you aren't wasting your time trying to find a carrier for someone who you later find out is making bolts for aerospace clients. I often receive phone calls from my retail brokers saying that they need a place of a machine shop. They never know exactly what the applicant is making or whom they are making the products for. So half the time when they call me back after gathering information from their client, they're letting me know that the client is making small parts for aerospace or automotive clients, which is really not something we're a market for. The next question is, do they also offer installation, service, or repair operations for their customers? We would want to know this in order to make sure we are accounting for this exposure. If subcontractors are hired by your client to perform these services, that needs to be accounted for on the quote. It's almost like they have a contractor's exposure along with the manufacturing exposure. So understanding their business process will help me to provide you with a bindable quote. What are their annual sales? This is going to be the rating basis for general liability coverage, and most manufacturing policies are auditable. So it is important to have the client provide an accurate sales amount. What coverages do they need? They may have contracts in place with their clients that require certain coverages. They may need specific additional insured endorsements or higher coverage limits. Knowing this information up front is helpful to us underwriters so we can find the right carrier for their needs. If they don't know what they need and you aren't sure, that's what we're here for. Give us a call, send us an email so we can help review the account with you. And lastly, is this a new venture or have they had prior coverage? This will help me to determine what markets I can go to for your client. We do have a product liability supplemental application available on our website, and this is a great tool to use when gathering information for your client. Now I'm going to turn it over to Darby.
Good morning, everyone, and thank you for providing that information, Teresa. So now I want to highlight some of the workers' comp underwriting questions that are going to be asked of you. Of course, along with a completed Accord 130, loss runs, and a potential supplemental application. These bulleted questions are some of the highlighted critical questions that are going to be asked. Most of these are going to be included in the supplemental application, so if the insured is providing one to you, it's going to save you some additional time. So these questions are critically important when underwriting a manufacturing workers' comp risk because they directly relate to employee safety, injury potential, and underwriting approval. So what products are being manufactured? Of course, you want to know the type of business you're insuring, but the type of product often dictates the complexity and danger of the manufacturing process. So you'll know what carriers you have available for you. For instance, metal fabrication, it carries different risk and a higher exposure than maybe food processing. For the types of machines, you want to make sure this percentage is equaling 100%. Are they heavy, mid, or light? So risk exposure varies with the type of machine. So insurers ask about this to accurately assess the risk to employees, price the policy appropriately, and ensure proper classification and safety practices are considered during underwriting. So heavy machines is going to be those metal presses, injection molders, large lathes, mid-level machinery, potentially woodworking saws or smaller machines, and that light machinery, maybe sewing machines or hand tools. The age of machinery is the next question that's going to be asked, and it's a key indicator of how safe or hazardous a work environment might be. It helps the underwriters evaluate both the frequency and severity of potential claims and price the policy accordingly, as older machines may lack modern safety features or be more prone to mechanical failure, increasing the likelihood of injury. However, follow-up questions you can ask the insured and provide that information to the carrier if they do have older machines are they retrofitted with safety guards? Is there a preventative maintenance schedule? Our next question is if employees travel off-site. If they do, you'll want to know how often and of course for what purposes, as off-site work introduces additional workers' comp exposures, and it can broaden the exposure to injuries, add complexity to claims. So understanding the frequency and purpose helps them price the risk appropriately and verify the proper classification. Machine guarded, is it going to be a point of operation or drive mechanism? It's important to ask this as these areas pose severe injury risk, especially for potential amputation, crush injuries, or lacerations. So lack of guarding is a top OSHA violation and a red flag for underwriters. So this is going to indicate whether the insured is investing in safety engineering controls. Our next question is accessible moving parts guarded on machinery or equipment. This question is going to be critical to determine if workers could accidentally come into contact with exposed moving parts such as gears, rollers, pulleys, or conveyor belts. As unprotected moving parts significantly increase the risk of serious or fatal injuries. So this reflects general workplace safety culture and risk management standards. And our last question is, does all machinery have proper guarding and any required lockout tagout systems? So these systems are used to control hazards during maintenance and repair work, ensuring machines can't be started unexpectedly. So this question is always going to be asked when underwriting a manufacturing risk. A lack of lockout tagout is a major cause of serious injuries and fatalities in manufacturing. So an established and enforced lockout tagout program demonstrates proactive safety policies. So underwriters use all of this information to evaluate the likelihood of maintenance-related injuries, which are costly and severe. So manufacturing operations present a wide range of exposures, from workplace injuries and equipment failure to product recalls and contamination risks. Through our next few case studies, Teresa and I will highlight how core coverages such as workers' comp, General liability, including products, completed operations, and commercial property form the foundation of protection. We'll also address some more specialized coverages like product recall, pollution liability, equipment breakdown, food spoilage, and inland marine. So by tailoring insurance solutions to the specific needs of each manufacturing operation, we want to help ensure our clients are protected against both common and complex exposures across the full scope of their production and distribution activities.
Darby, before we go to the case studies, it looks like we have a couple questions. I think the first one might be for Teresa.
I think so. Let's see. So you're worried about the annual sales estimate. So under the general liability, that is the rating exposures, annual sales, which are annual revenues. How much are they bringing in every year? Can you please explain how the minimum and deposit? I'm not sure what you're referring to for minimum and deposit. Are you talking about minimum earned premiums for a policy? Typically for general liability, the minimum premium is going to be $500 to $750. It just depends on the type of manufacturer and what carrier I have to go to. If it's a higher exposure, you could be looking at a $1,500 to $3,000 minimum general liability premium. But general liability is rated on annual sales, annual revenues. So I hope that makes sense.
Okay, and it looks like the next question is for me, is drive mechanism referring to mobile equipment like a forklift? So the drive mechanism involves belts, gears, and other parts that transmit powers. It's much broader than just referring to a forklift. While a forklift certainly utilizes a drive mechanism to move materials, it's just one example of the many types of equipment that fall under this umbrella. And I'd be happy to, after the webinar, to speak further in depth about your specific question if you have anything further.
We do have a couple more questions coming in right now. Another one on the annual sales, Teresa, if you want to take that one.
Yeah, absolutely. So for the annual sale, if customer has service warranty for the products they sell, will we need the separation of sales figure for sales and service? No, we will take a combined annual sales. We're not taking anything out of that sales figure. We're taking the annual sales, and if they do have a installation or service repair exposure, we're going to be taking the payroll of those people, and that's if they're not subcontractors, if they're actual employees of the insured. It depends on the carrier and how what class codes I need to bring in, because something like cabinetry, all I need are the annual sales, and that's going to include the installation and the manufacturing. But for a different type of manufacturer, maybe a sign manufacturer and installation, I'm going to take their annual revenue, total annual revenue, and that's how I'm going to rate the manufacturing exposure. And then for the sign installation, if it's a sub, it's going to be rated on how much you are paying the subcontractors. And if it's an employee doing the installation, I need a rate for the employee payroll. So just the payroll of the people performing that installation of those signs. And I see another question, are there admitted carriers writing manufacturing risks, or is it all E&S? Honestly, 98% of my GL and property business is non-admitted. There are one or two possible admitted markets out there that I may be able to access, but like I said, 98% of my business is going to be non-admitted. The admitted markets, I don't get a lot of things that have 3 to 5 years loss runs, or that are light manufacturing. If I do receive something like that, I may have someone, like a Hartford I can go out to and get a quote from. But typically I am going non-admitted.
Alrighty, and that last question regarding an audit, if it's going to result in either a debit or a credit, because we don't have one-way audits. So the audit's always going to occur at the end of the policy period, whether that be a cancel or fulfill its entire policy term. It's going through that audit, and whether it results in a debit or a credit is based off of the payroll being verified at the end of the policy term. So if it ends up being verified higher than what we originally wrote it at, it would result in result in premium being owed to the carrier, and if it was verified to be lower than what we wrote at the beginning of the policy term, then the insured would receive a credit or a refund. Okay, so moving forward to our first case study. So in our next series of case studies, I'm going to be addressing the workers' comp coverage and walk you through the business profile while providing a brief underwriting analysis, and then Teresa is going to guide you through the P&L coverage. So Glacier Bite Foods, Inc. is a frozen food manufacturing company with over 9 years of operating history and 2 production facilities located in Arizona. The company specializes in the production of frozen entrees, vegetables, and meat-based meals with an annual payroll of $300,000 and an experience rating of 123%. The account presents both opportunities and areas of concern from an underwriting perspective. The business's longevity, established operations, and defined workflow suggest stability. However, the elevated experience mod indicates prior loss activity that requires deeper evaluation before quoting. So understanding the insured's operations is critical in determining the correct class code, exposure basis, and overall risk profile. Glacier Bites employees are engaged in food prep, product assembly, packaging, and material handling, all of which involve repetitive tasks and exposure to cold environments. So this is going to help the underwriter assess the likelihood of injury types common to food manufacturing, such as slips and falls or wet freezer floors, and lacerations for maybe knives or machinery. So accurate classification of employees ensures the correct application of payroll to the right workers' comp codes, which directly impacts premium rating. The presence and enforcement of PPE, including some steel-toe boots, gloves, freezer coats, are positive underwriting indicators. These controls mitigate the severity of potential injuries and reflect the employee's commitment to safety compliance. So understanding PPE usage also aids in evaluating the company's preparedness to prevent injuries and support loss control initiatives. The elevated experience rating of 123% suggests that the insured has experienced either a high frequency or severity of claims throughout their policy period. So a thorough review of loss runs is going to clarify whether the losses were preventable, isolated, or part of a systemic issue. This rating also is going to influence pricing, may necessitate scheduled debits, or enhance safety services in the quote. So by gathering and analyzing this information, we can ensure the account is rated properly, priced competitively, and supported with services that reduce future claims, frequency, and cost. So a thoughtful underwriting approach is going to position this insured for long-term success with their workers' comp program while mitigating carrier exposure.
Great. And since they haven't been in business for 9 years, you know, you're looking through all the coverages they currently have and what they're looking to get at renewal time. We're seeing that they're in need of, you know, general liability to include products completed operations. They're looking for a blanket additional insured for their vendors. This is very typical when you are a food manufacturer, you have your items on the shelf at all these different grocery stores. They're going to be requiring an additional insured for all the stores that you are selling in. And it looks like they're going to be needing some business, personal, and property coverage for their equipment and stock. And after asking, you know, all the various questions about their operations, you're definitely going to want to recommend equipment breakdown coverage to cover any types of damages that may occur to their freezers. This is a huge part of their business. They're a frozen food manufacturer. They're going to have a lot of frozen and refrigerated items. So you're going to want to make sure that those are covered. And food spoilage is going to be another huge one to cover their perishable items. And then business income for any interruption in their business operations, and product recall in case any items need to be taken off of the shelf. Product recall, you're looking at about a $1,500 minimum premium for a coverage like this. And in a frozen food manufacturer, it is a very prevalent. This is occurring more and more often in this type of industry. And it's very costly to have to remove all of those products off of the shelf. So product recall is a nice little additional coverage to offer your clients. The next example we have is a men's clothing manufacturer, Nova Thread Manufacturing LLC. They have one location in California and have been in business for 5 years, so they're pretty well established. Annual sales are $5 million, payroll of $550,000 with an experience rating of 86%. The employees perform cutting, sewing, pressing, and packaging. Machine guards and a lockout, tagout program are in place for the machines. And their coverage is being non-renewed because the carrier is exiting the market. I know we're all seeing a lot of this lately. So they're in need of finding general liability coverage to include products, business personal property coverage for their stock and equipment, and equipment breakdown coverage for their equipment and business income. And Darby, what do you see in this one?
Yeah, so this company maintaining a single production facility and having an impressive experience mod rating of 86%. It's indicating a strong claims history on the work comp end and proactive safety culture. Of course, with the employees' duties and the exposure that's involved, you're going to have some repetitive motion injuries, slips and trips, equipment-related injuries. So having a strong safety program in place is going to be really important. That is why with this insured, having those machine guards and lockout, tagout programs, it's a favorable underwriting indicator, especially in environments where industrial sewing machines, heat pressers, or automatic cutting tables are used. So from an underwriting standpoint, the risk overall suggests effective claims management, solid safety practices, possibly a strong return to work program. And the fact that this is being non-renewed due to market exit rather than performance-related issues should be viewed as neutral when underwriting the risk. So in summary, this presents a well-run, safety-conscious operation with a strong mod, proven safety infrastructure, and no known adverse loss history. So this is going to be a highly marketable and profitable risk for the right carrier. In our next case study, it is Craft Edge Cabinets, Inc., and it's a cabinet maker in Texas that also performs installation with one location. Annual sales are $300,000, and they are a new venture. The annual payroll is going to be around $80,000. Of course, this isn't going to be experience rated for the workers' comp, as it is their first time obtaining coverage. Employees perform custom residential and light commercial cabinet manufacturing and installation, and the coverages needed are work comp, GL to include products, BPP for their equipment and inventory, equipment breakdown, and inland marine coverage for miscellaneous equipment and tools.
Yeah, and going more into the inland marine coverage, because they are going off premise to perform, the installation, it is important to offer that inland marine coverage for those equipment and tools that are leaving the job site, or that are leaving their office location and going off to the job site. You are not able to include that under the business personal property because BPP is only for items that are going to be staying at their office location. But overall, this is going to be this could be a really great risk to go after because they are a new venture. A lot of carriers do not want to pick up a new venture, but we want to make sure that they've been in this industry, you know, maybe as an employee, working as a cabinet maker for a few years, just so we know that they have that background experience and are taking the proper precautions. When you're working with wood, fire is the #1 hazard. So carriers are going to be on the property side, making sure that all precautions are being taken. So we hope these case examples help give you a better understanding of what coverages to consider for the different types of manufacturers, because there's such a broad range of manufacturers. Jacob, thank you. Important things to remember about today's webinar are to ask questions and gather information. The more you understand about their business and process, the more you will be able to help your client, because these manufacturers are unique in their own way and will have different coverage needs. And we are here to help, so don't feel like you have to figure it out on your own. Give us a call or send us an email and we can help work out what options are available to your clients. And when looking to obtain a general liability and property quote, I will need a completed Accord 125, 126, and 140, along with a product's liability supplemental, loss runs if they've had coverage, and an inland marine app if that is a coverage they are looking to obtain.
And for the workers' comp, you're of course going to be providing an Accord 130, which is the foundation of the quote, the manufacturing supplemental application, which is located on our website, and it does provide those questions that are going to be asked by the carrier, so it's going to save you and the insured a lot of time. Physical loss runs are going to be required 4 years if applicable to help underwriters assess the frequency or severity of the claims, and it's key for pricing the risk. And then if the insured does have a safety and loss prevention program in place, this is always helpful to provide, as it demonstrates the company's commitment to injury prevention and risk control. So all of these documents that Teresa and I mentioned are going to help the underwriter accurately assess the risk, determine appropriate class codes, price the policy competitively. So submitting complete and accurate information up front speeds up the quoting process and improves the likelihood of securing favorable terms.
All right, before I go into this slide here, it turns out the audit question that was asked earlier was actually regarding the GL. Teresa, there's a bit more explanation there if you want to take that.
Okay, got it. So audits on the GL side vary not only by state, but by carrier. So if we're talking about a risk in California with a non-admitted market, you do have to be really good about estimating your sales. So if they've had a few years in the business, you know, looking at your profit and loss statement, your income statement, that will help determine what your next year's annual revenues are going to be, to help better estimate what they are. Because when it comes to an audit in California with a non-admitted carrier, you're more than likely not going to get your money back if you did not meet that threshold. So let's say you put, we rated 300,000 in annual sales, and at the end of the year, end of the policy term, it turns out you only had 250,000 in annual sales. You're not going to be getting any money back for the $50,000 in sales that you were over. But you know, when it comes to non-admitted markets, if you are audited, you will be getting a refund for that 50,000 in sales that you didn't meet. But it does vary by carrier and by state, and I'm more than happy to go through that with you with every quote that is sent out, and it is also a part of our quote cover sheet so that nobody's blindsided.
Okay, perfect. All right, so now let's talk about how to actually go out and find more manufacturing clients. First, you can try tapping into your existing book, look for clients who are distributors, importers, or even contractors. Many of them either manufacture themselves or have connections to someone who does, so this is kind of low-hanging fruit that's easy to overlook. Second, you can try to network locally, maybe trade shows, Chamber of Commerce events and industry mixers are great opportunities to meet local manufacturers face-to-face. Third, you can try digital marketing. You can post on LinkedIn or Facebook, search for manufacturer groups, make sure your profile clearly shows that you write this type of business. On LinkedIn, you can look specifically for job titles like operations manager or plant owner to find the decision makers. We actually just did a whole webinar on local and digital marketing, so I suggest you check that out if you haven't seen it already. I'll go ahead and include a link to it when I send out my follow-up emails to you all after the webinar today. Okay, last thing here, you want to position yourself as the expert. You guys kind of know this already, but after this webinar, you now understand the coverages these businesses need, and through CID, you have access to markets that can write the business that your standard markets would likely decline. One other thing, I put together a new marketing flyer. So it highlights the key coverages and eligible manufacturing classes, and there's a spot at the bottom for you to drop your name in and your contact information so you can start using it with prospects right away. So that's on our website, but I'll also send it to you all in my follow-up emails. All right, let's see if we have any more questions. Okay, looks like we're good. If you guys have questions that we didn't answer, go ahead and chat them in now so we can answer them before we sign off. And then after we do sign off, I encourage you all to browse our website. We have tons of tools for you to use. Marketing flyers, like I said, professional proposal templates, our fillable applications are on there, and a ton of recorded webinars just like this. So don't hesitate to reach out to Teresa and Darby after the webinar. Their contact information is on the screen here. And if you have completed applications on file, you can start sending them over to the submissions email that you see on the screen. Please be sure to stay on so you can complete the 3-question survey and help us make these webinars better for you in the future. So it doesn't look like we have any more questions, so that'll do it for today's webinar. We appreciate you all joining us, and we look forward to doing business with you. Have a great day.